The current market is open, and as of this moment, BigBear.ai Holdings Inc., trading under the ticker BBAI on the NYSE, sits at $5.44, reflecting a slight intraday dip of minus 1.36% from the previous close, following a volatile pre-market and early trading session. Now, the common expectation built around BBAI, largely fueled by a handful of explosive weekly rallies this year and the pervasive hype surrounding government-facing artificial intelligence plays, is that this stock is a pure, unadulterated growth story ready to soar on the back of massive military and national security contracts. That's the narrative that gets repeated across social media and retail trading platforms, painting a picture of an inevitable ascent. But here is the critical angle that the daily price action masks. The recent bottom-line beat in the third quarter wasn't primarily driven by surging revenue from their core operations, but rather by a significant, one-time, non-cash gain from the revaluation of derivative liabilities related to the convertible features of their debt. This is the unexpected reality, a technical financial engineering twist that fundamentally changes how we must interpret the subsequent stock movement and the true nature of their recent positive earnings, a crucial detail often lost when headlines simply shout, "earnings beat." The general belief, particularly after the Q3 2025 report earlier this month, was that BigBear.ai was finally showing consistent traction. The company did indeed report an earnings per share of minus $0.03, beating the minus $0.05 consensus forecast. But the deeper context reveals a revenue decline of over 20% year over year. The core business revenue is shrinking, primarily due to lower volume on certain Army programs, a significant factor that analysts were quick to point out. This contraction in the top line, which is arguably the most vital metric for a growth-stage software company like this, directly challenges the expectation of explosive imminent growth. The stock's volatile response since the report, a quick surge followed by a steady slide back toward the $5.50 level, is a perfect reflection of this tension between the headline beat and the underlying financial reality. High trading volumes, often topping 50 million shares a day recently, show a clear tug-of-war between those trading the earnings surprise and those with a more granular view of the slowing contract revenue. Drilling into the recent trading pattern, the stock has been technically range-bound since the post-earnings spike, struggling to sustainably hold above the $6 psychological barrier. Institutional activity in the preceding quarter, as per 13F filings, shows a mixed bag, which further complicates the narrative. While large holders like Vanguard and BlackRock have substantially increased their positions, suggesting long-term conviction in the AI defense space, others like Citadel have slightly decreased theirs, a divergence that hints at a fundamental disagreement among smart money regarding BBA's valuation at this level, especially given the revenue headwinds. The stock's beta, a measure of its volatility relative to the market, remains remarkably high, currently sitting north of 3.00, confirming that this is an exceptionally high-risk, high-reward proposition that moves far more dramatically than the broader indices. This volatility is precisely what attracts the retail crowd, often trading the daily swings rather than the underlying fundamentals, which is a dangerous approach given the current lack of a clear, strong technical trend. Let's pause on the core business model for a moment. BigBear.ai provides AI-powered decision intelligence solutions, largely to the U.S. government, especially within the defense and intelligence communities, which is its source of the next Palantir narrative. Their core offering is predictive analytics, helping large, complex organizations with mission-critical tasks by integrating and making sense of massive data sets, a capability that is undeniably valuable. They operate through two segments, government and commercial, though their government contracts are the major driver of their current backlog, which as of the last report stands at a solid $376 million. The expectation here is that their deep ties to the Department of Defense and other agencies provide a resilient, high-margin revenue stream. However, the reality, as evidenced by the recent Q3 revenue drop, is that government funding cycles and program timing are inherently lumpy and can lead to sudden, sharp declines, which is what happened with the lower volume on certain Army programs. This dependency is a double-edged sword, highly secure and potentially lucrative, but susceptible to political and budgetary shifts. Now, turning to the critical area of short-selling awareness, this is where the expectation versus reality dynamic becomes most intense for BBAI. The prevailing market chatter, especially across forums like Reddit, suggests that BBAI is a prime short squeeze candidate. The reality is that BigBear.ai is undeniably under significant short seller pressure. Current short interest is substantial, sitting at approximately 18.32% of the free float, representing nearly 80 million shares sold short. The DTC ratio is currently low, around 0.74 days, meaning it would take less than 1 day of average trading volume for short sellers to cover their positions. While a high short interest percentage signals strong bearish conviction and the potential for a powerful squeeze, the low DTC suggests that any potential squeeze would be short-lived and relatively easy for short sellers to manage, as liquidity is high enough to allow for rapid covering. This counter-narrative of a quick, powerful squeeze versus a technically contained short position is a vital distinction for retail traders to understand. Moreover, we are seeing a small but notable increase in the short borrow fee rate, though it remains relatively low, peaking recently around 0.95% on a daily basis, which is a key metric. A sudden spike in this fee is a better indicator of immediate short demand pressure than the static short interest figure alone. The presence of sophisticated short-focused institutions is evident in the filings, and their primary thesis revolves around the high valuation, a price-to-sales ratio still in the mid-teens, for a company with shrinking top-line revenue and inconsistent profitability driven by non-operating factors. Their bet is simple. Without tangible, accelerating revenue growth, the stock is overvalued, and the recent acquisition of Ask Sage for $250 million, while strategic for its generative AI capabilities, comes with its own financial cost and integration risks that the bears believe will weigh on the balance sheet. Investors who want to monitor this situation closely should track the NYSE-published short interest data, which is released twice a month, and pay close attention to the prime broker's intraday borrow rates, which are a real-time gauge of short demand. Do you think the government's need for advanced AI will eventually overpower the short thesis on BBA's valuation? Or are the bears right to focus on the shrinking revenue? Comment below with your take. The future outlook for BigBear.ai hinges on two major catalysts that will either fulfill or crush the market's high growth expectations. The first is the successful integration and immediate commercialization of the recently acquired Ask Sage platform. This acquisition is touted as a strategic pivot into secure generative AI for the defense sector. If Ask Sage immediately begins to win large, visible contracts and drives meaningful revenue growth in the first half of 2026, it could be the fuel the stock needs to break decisively above its 52-week high. The market is expecting this purchase to be a true growth accelerant. So anything less than a significant, verifiable bump in the commercial segment or new government contracts will be viewed as a massive disappointment. The second catalyst is the international expansion exemplified by the Memorandum of Understanding signed with the Pahang Aerospace City Development Berhad in Malaysia. While an MOU is a non-binding first step, it lays the groundwork for BBAI to apply its expertise to a major aerospace, security, and transit hub in Southeast Asia. This expansion is an opportunity to diversify their revenue away from the lumpy U.S. government contracts, but it also introduces foreign regulatory, political, and operational risks that are currently not factored into the stock price. The risk profile is significant, extending beyond the current short pressure. The stock's massive cash position of over $450 million reported in Q3, secured through a substantial equity offering this year, provides a powerful buffer and the capital for the Ask Sage acquisition. However, that same cash on the balance sheet can be viewed as a necessity given the company's negative operating cash flow, which was minus $9.58 million in Q3, a significant year-over-year increase in cash usage. Furthermore, the reliance on non-cash gains, such as the derivative revaluation, to present a positive net income highlights a deeper issue. The business is not yet structurally profitable from its core operations. Retail investors attracted by the short squeeze narrative or the AI and defense hype need to understand that this is not a financially mature company. They're trading on potential and the strategic value of future contracts, not on current sustainable cash flow. In summary, the narrative driving BigBear.ai is a story of immense near-term potential in the high-growth, high-security AI defense sector, bolstered by a strategic acquisition